All right, welcome everyone to our webinar. This is part two of the first webinar that we held about 3 weeks ago, where we touched on challenges that we all face in the alternative financial services industry. I'm going to give everybody just a few seconds to get logged in since we just went live. So 30 seconds, stand by, and we will be right with you. All right, so welcome everybody to our webinar. This again is a continuation of the first webinar we held about 3 weeks ago, where we touched on challenges that we all face in the alternative financial services industry due to the pandemic. And we have our panel of industry experts back again to give us some practical advice and solutions on how to navigate lending in this weird upside down pandemic world. So 3 weeks ago, we looked at the status of the industry with what few metrics that we had. And we looked at the impact of defaults on lenders and what lenders could do to fund loans during the pandemic. Today, we want to cover key topics on a more granular level. And our panelists have been collecting data during the last 3 weeks. And our aim is to use this data to give you a more rounded picture of the best way to continue finding good borrowers and funding loans in this COVID-19 era. First, let me introduce our panelists. And I'm not going to go into great detail here, but I do want to highlight Blake Sims, partner at Hudson Cook. Hudson Cook is a boutique law firm that does nothing but consumer finance work, so they really are experts in this field. I am also convinced, you can read about all the great things about Blake on his resume there, but I'm convinced that John Grisham's exciting legal thrillers were based in large part on Blake Sims' life. If you can get to know him, this guy is an exciting guy, and there's nothing boring about the practice of law. So we're happy to have Blake with us. We're also fortunate to have George Koutros, Clarity Services Chief Revenue Officer. He's going to give us some new insights on the data they have been collecting. And George has a wealth of experience in our industry, including as a direct lender. So we appreciate his insights. George, it's great to have you here. By the way, George has a master's degree in statistics, so he can run circles around most people when it comes to data analytics. Great asset to have on the webinar today. And then we have Phil Richards. So Phil is our British import. Phil is fantastic, plugged into the industry. He does a great job liaising with our lenders. And Phil, as our UK import, has been instrumental in helping me understand the difference between cookies, crackers, biscuits, crisps, English muffins, and crumpets. So if you have questions about what those are, and they're all separate things, believe it or not, Phil's your guy.
I know nothing about Leeds, but please talk about cookies anytime you like.
Crumpets are what always confused me. So here's a quick look at our agenda for today. We want to talk about trended performance of leads and loans, score bands, verification trends, data on acquisition costs per funded loans. We had a lot of questions last time about that. We want to cover a media traffic overview and then get into some legal analysis so we're all doing what we should be doing as protected and as safe as possible. Before we get into that, I want to go back to the panelists and ask them to just take a couple of minutes and share with us what has happened over the last 3 weeks. Kind of a general question. I know we're going to get into details later, but let's just go around the virtual table here, first with George and then Phil and then Blake. Guys, give us a 2 to 3 minute summary of what you think is relevant that has transpired over the last 3 weeks.
Sure, and once again, I'll keep it short and sweet because I know we're going to be looking at a lot of these things in a lot more detail throughout the webinar. But, you know, some just general observations. Demand still isn't where we all want it to be, right? But there are obvious explanations for that, right? Why aren't people seeking AFS loans, small dollar loans? We're coming on the heels of, I mean, it wasn't too long ago that people were getting tax refunds. We're talking stimulus checks. We're talking some fairly robust unemployment insurance benefits for a lot of folks, right? So, in many cases, consumers from a financial perspective are in better shape than they normally are. And then the other thing to keep in mind is, until things start to open up state by state, most consumers are spending a lot of time at home. They're not driving to work. They're not engaging in a lot of entertainment related activities and stuff. So if you think about it, if one of those typical emergency expenses is something like repairing a car, if you're not using your car much, then there's certainly not going to be as many, car repairs that are required and stuff. So lots of different reasons that are basically behind the reduced demand for AFS loans. Second point, we talked a little bit about in the last webinar about how at Clarity, we are seeing, a greater percentage of consumers that we typically don't see in this marketplace. And so we can continue to see that trend hold up over time. And I'll dive in more details there and try and give some explanations for that. And then finally, I'll just end with, what I consider to be a positive note. And I know I've engaged in conversations with many lenders and they've communicated this, but the data also corroborates the fact that there's been no deterioration in loan performance for recently funded loans. For example, for loans funded in the first 3 months of the calendar year, right? And so I think that's a real positive. And we'll dive into that in more details and talk a lot more about that.
Excellent. Phil, from your perspective, what's been happening?
Thanks. Yeah, as George said, obviously there is still not as much volume, to put it mildly, as there was before the pandemic. However, we are still seeing about half the posts that we were before. Now, in terms of posts, that's still 400,000 or 500,000 posts a day, which is still a lot. Now, within that, there are new customers, people on different benefits and in different employments and so on. So there is a different mixture of customer. That volume, particularly in the last 3 weeks since we last spoke, has steadied. We are seeing a pretty steady amount of volume each day. And in the last 7 days or so, since Florida, Texas, and now California have partially reopened, those states have seen an uptick. In fact, there's been a bit of an uptick overall, because it's not just those 3 states, there are some other states involved. So, well, the good news is that the volume, reduced as it is steady where it is. And there are, within that, ways that lenders can obviously fund loans. Now, what we are seeing, obviously, conversion rates for some haven't changed. I want to be clear about that. But there's no doubt that others are having challenges. And that's driven by new SSNs coming to the system and lack of data and so on, returning customers benefiting from stimulus checks and so on. So within that, we're seeing a lot of innovation. Lenders are finding new ways to fund new customers, maybe some things that they weren't doing before. We've had some very interesting conversations with lenders recently who've come up with completely new ideas. Why? Because they're sitting on a lot of cash right now compared to what they expected. So, why we're here today is to how can they put that onto the street safely, compliantly, and get a return.
Good. Blake, from your perspective, where are we now over the last 3 weeks from a legal side?
Sure. Yeah, and Jason, legal issues tend to trail, data points and things like that. So sometimes it's difficult to see in the moment what are the big legal issues that are happening. But we do have some indications that we look at and we see. Obviously, I think the political statement is don't let any good crisis go to waste. And I think you're seeing that from some of the advocacy groups and frankly, from the industry as well, pushing both sides during this pandemic. The advocates are pushing usury limits, debt collection restrictions, and reporting issues, while the industry, I think just today, I think it was a letter was published from 21 AGs saying that we need to look at litigation protection because they're anticipating a lot of litigation coming out of the pandemic. So that's what we're seeing from a debt collection side. There was a House bill introduced to limit collections. There's been pushes to restrict collections on stimulus checks. Some of you may have seen the article out of Utah about an increase in payday complaints. And then I think where we're anticipating the most litigation to come from Jason, is FCRA out of the CARES Act. And I'll get into that in a lot more detail later on.
Good, excellent. So I appreciate that summary, guys. And for those of you on the webinar that are joining us for the first time, if you have questions, please use the Q&A tool that is in your toolbar on the Zoom window there. You can submit questions, and I'm going to try and keep an eye on those questions as we go through this discussion. So if it's thematic to what we're talking about at the moment, I'll put those questions to our panelists. If we don't have time to get to it during the discussion, or if I miss it for some reason, we may have time at the end to go through your Q&A questions there. And if we don't get to those questions during the webinar, we will follow up with you either individually, or if we see a lot of themes arise, we'll plug that into our lender newsletter. So you'll have a chance to get your questions answered. Please feel free to use that Q&A tool that is part of the Zoom platform. Now, here's one thing that we want to get your insight on as the lenders is we're gonna give you an opportunity to share with everybody here what your current pain points are. So we have one poll. This is going to be the only polling question that we ask. And this is an anonymous poll. So I'm going to put the poll up here. And the question is, as a lender, what are your top 3 pandemic pain points right now? You can answer 1, 2, or 3 or more if they're applicable, but try to think of the top 3 pain points that you're experiencing right now. And I'll give you guys a few seconds, 20 or 30 seconds to take a look at these and select this. Now, because it's anonymous, you don't have to worry about the answers being associated with you individually, but this will give everybody a real idea of where the industry sits, where our peers are sitting as far as their relevant pain points. 10 or 15 more seconds. We've got a bunch of answers coming in already, and we're well over 50% of the attendees voting. So I'm just going to give that a few more seconds to see how this goes. Okay, 5 more seconds, and then we'll end this poll. Still see votes coming in. This is fantastic. Appreciate you guys' participation in this. It's a very interesting view. Okay. So let's take a look at what you guys said are the real pain points here. And it looks like clearly the winner is lead quality and conversions. So Phil, not to put too much heat on you, but you are, aside from the UK expert, you're also the lead expert here. So I'm sure you're going to address lead quality and conversion later in the discussion, but let's keep that top of mind because that's the highest pain point right now, followed, interestingly enough, by lead volume is too low. So that's fascinating. And then a distant third place, it looks like underwriting is less predictive. And George, I know you've got some very significant insights into the lead volume. One last thing that I will note is somebody sent me a message just now and said that when we pull up the slides for the visuals, there is some distortion or some lag. So if that happens, feel free to send me a message in the Q&A. We don't necessarily have to have the slides up, but we want you to see some of the data that we've gathered. If it's an issue, we'll pull back on the slides. But for now, let's turn to George, and let's start by talking about loan performance. George, you mentioned that delinquencies are not really an issue at the moment. So can you talk about the data that you have that supports that?
Sure. So yeah, I mentioned in my opening remarks that loan performance has held up quite nicely. So what I want to do is focus on AFS loan performance, specifically loans that were recently funded. So January, February, and March of this calendar year. We're going to look at first payment default rates for both online payday loans and online installment loans. And the first thing I just wanted to say was, why focus on first payment default, right? I know that a lot of online payday lenders certainly focus a lot on first payment default, and online installment look at that measure as well, in addition to many other metrics. But a couple of reasons for why I think it makes sense. Number one is you can get a quick read on what's going on, right? Because you only require a limited amount of seasoning of loans to be able to measure whether it's a first payment default or not. But then secondly, right, if you think about what's going on as a result of the CARES Act, which has impacted how lenders are able to report delinquencies on consumers that have asked for accommodations. In my mind, the default measure, the delinquency measure that's going to be the least impacted by some of that different kind of reporting is going to be looking at a first payment default, right? And so those are the reasons why I felt like it was appropriate to focus on first payment default. And so as you look at these bar charts on the top, it's really looking at year over year first payment default rates for online payday loans. Obviously month to month as you go from left to right. In the lighter blue, that's gonna characterize first payment default rates for online payday loans in 2019, all the way to the left in January, and then dark blue is for 2020. And so, what you pretty much see is it's a push, right? Comparable first payment default rates year over year from 2019 to 2020. And then similarly, if you look at the bar chart on the bottom of the page, right, it's the same idea, only for online installment loans. And once again, what you see is that comparable or maybe a little bit of a dip in first payment default rates for the recently funded installment loans. However, I would just like to end this little this slide with just the comment that you need to be a little bit careful when trying to extrapolate these results forward, right, throughout some lengthened, pandemic protected period, right? Because many things can impact these kinds of results, right? I mean, we don't know whether there's going to be a follow-up stimulus. We don't know how quickly people are going to burn through their existing stimulus checks, or when they're going to return to action and start doing more activities where maybe more, emergency expenses start hitting and stuff. So there are too many factors, right, to kind of control for. So I would just say that the read right now is great from a performance perspective, but that doesn't necessarily mean that it's going to continue to be that way for some elongated period of time.
Got it. And I assume that that's even more complicated when you start thinking about severance or stimulus checks that have gone out. Some people got them early on, other people still haven't received them yet. And the same with unemployment. Some states are still flooded with applications that have yet to be processed from last month, which is going to kind of spread out this issue that you're talking about. It's a fascinating situation. Let's talk about new customers that are coming into the system. So I know Clarity has seen some new customers coming into the system. Let's go over the data that you have and kind of understand what you guys are looking at from Clarity's perspective on new people.
Sure. So, one of the metrics that we look at when we're evaluating consumer applicant profiles is we look at the percent of inquiries or consumer applicants that have previously been seen by Clarity, right? So in this case, we're showing that kind of steady state, right? Before kind of pandemic really started changing things, was that, we typically see of all the consumer applications that we see, maybe 5 to 6% are, with respect to consumers that Clarity has not seen before. And over the course of the last 4 or 6 weeks, we've seen that trend up to where the overall amount now is closing in on, close to 8%. And so rather than just try and make some big generalizations, we then try and dive in to kind of understand what are the factors that are influencing that, right? And so while we know that we are seeing some new consumers showing up, applying for AFS loans, another thing that we know is that it's the types of inquiries that we're seeing, and it's the mix of that business that could also have an impact as well, right? And so what we typically, do is we would break this down and we'd look at, okay, let's track this metric for the online payday and online installment inquiries. Let's track it for online rent to own. Let's track it for, subprime auto finance inquiries coming through. And what you see is that what's really driving this, it's a combination of things. Yes, we're seeing some new customers coming into the fold looking for AFS loans, but we're also seeing a change in the mix of the different inquiry types that are coming through Clarity.
So this new to Clarity slide that is up now, can you give us a sense of what that slide is conveying? And then we've got another slide that is by industry type. Let's go over those two slides real quick.
Yeah, so this first one just shows starting in, or in early March, right, of the consumer applications that we're seeing flowing in through Clarity. About 6% of them are for consumers that Clarity's never seen before. And then over time, you see it trend up toward all the way to the right, toward late April and beginning of May. You start to see that number be closer to around, close to 8% almost.
And
then I had referenced in this next slide, I had referenced that we break it out by actually, inquiry loan types. And so in the top left, I'm showing that same metric trending over time for online payday and online installment. On the top right, I show it broken out for storefront and other Clarity loan types. And then down below, lower left, we show it broken out for online rent to own, as well as a subprime auto. And so the comment was, right, you typically see it trending up. I mean, I think the one that really kind of bucks the trend, that's either not been consistent or not trending up some, is the storefront, AFS, loan type, right, which is kind of trended downward. Right, but and once again, we just dissect it in a way, we segment it in a way to try and understand what's behind that elevated, metric value, essentially.
so I appreciate that. Let me jump over to Phil for a minute. Phil, you have a lot of data on leads coming into the system. So how does that corroborate the information that's coming out of Clarity, or is there a corroboration, or is there a conflict in that data?
Yeah, thanks, Jason. We certainly see that same pattern of new SSNs. I think the next slide shows that in 2020, that slide goes from middle of January. And as you imagine, when the quiet season hits us, the volume of particularly new applicants always trends down. So 17% to 14, or new SSNs rather. And usually that would continue going or flatten, somewhere around 14, 13, something like that. But obviously when the pandemic hit in March, it's been trending up ever since, and exactly 2 to 3 percentage points, as George said. So essentially we're seeing exactly the same thing. It's a slightly different time scale than the Clarity one, but pretty much says the same thing. And that means that there are SSNs, not just that Clarity hasn't seen before, the LeadsMarket hasn't seen before either, coming into the system. People who haven't previously needed or been interested in a subprime loan product. And that's interesting. And that's, one of the things that lenders are going to have to sort of grapple with our help, with Clarity's help, as how they can offer funding to these people and try to predict the outcome without a lot of historic data.
So Phil, I think that kind of begs the question, who are the new consumers that are coming into the system?
Yeah.
Are these the unemployed? Are these people who, had credit cards that are maxed out now? The info that I've been reading is credit cards are being paid off in rates we've never seen before. But so who are these people? And also, what are the conversion rates specific to the new customers coming into the system?
Yeah, thank you. Same assumption I made very early on. I think we expected the new SSNs we were seeing to be those that were unfortunate to be out of work right now. And in fact, we ran an analysis this week to look at the proportion of those on benefits to those in employment before and after COVID. And actually, it hasn't changed much, which is quite a surprise. Which begs the question, okay, well, who are these new SSNs that are in the system? So we looked at the employer names, the industry types, and so on, trying to find a pattern there. And actually, it was a very mixed blend of employer names that these SSNs were made up of. Again, fascinating data. People who are currently employed who weren't looking for loans before coming into the system. And that's obviously affecting conversion rates, plus the overall, situation in the economy. So there's a few factors there. Sorry, Bill.
So you gave me a slide about Amazon that I want to share with people. So you kind of give us a breakdown of what we're looking at here with this slide and how it relates to new people coming in and opportunities for lenders here.
Yeah, this slide shows the percentage of new SSNs we're seeing within the employer name Amazon, for example. And this is something that we were aware of in the last webinar. We knew that CVS and so on were hiring. Pizza Hut and DoorDash, as an example, usually rank 50 or 60th within the most seen employer names. Right now, they're up to 35 and 36. And here's a great example of 2019 is in blue. You can see that the Amazon new SSNs was fairly flat. It went up a little and then trended down. But literally, from March to April, it shot up 2 percentage points. So these are people who are new to us, probably new to Amazon. And this also relates to another slide we have later, which is talking about certain professions paying attention to certain media and so on. So I'll tie that up a bit later. In terms of conversion rates, it's a mixture. I want to be clear that we've been very surprised by some lenders' conversion rates have been stable or even higher, and we've asked them, are they doing anything different? And they've just said, well, not really. And I feel like their underwriting model was actually suited to the sorts of customers that we have coming in right now. And I think there's a debate we can have, and we probably should have, and we are having with lenders every day, is that is your underwriting model something you need to adjust right now for the new circumstances? Now, the new circumstances are quite uncertain, but as George said, there are some other data points that Clarity or other, bureaus could leverage to help make those predictive decisions right now. So a lot of our work with lenders who are having issues with conversion is to look at, do they need to change price point up or down? There's a premium on the quality traffic right now, as well as trying to mitigate the poor quality traffic. So, try a lower price point, try a higher one too. You'd be surprised. Also, try thinking, is there a product we would never have offered before? And is this a time to maybe consider it? We've actually had, again, very interesting conversations with lenders right now who are saying that they want to try a completely different product with a completely different loan term for a completely different income schedule. And that's very fascinating. And we've run tests for the last few months with several of those. So I would definitely encourage lenders to think outside the box. We'll help you refine the sweet spot on the tree. The ping tree dynamic has certainly changed. Where prices are the same and conversions and demand are lower, of course, the CPFs are challenging for at least half lenders, I would say, definitely want their conversions to be higher. It's across the board, I believe, with all lead providers. And what we can do as a network, we've always generated more of our own traffic, and I'm sure other networks do that too. So you want to try to rely on traffic that's generated by the network so you can control the marketing and the conversion. I think that's another thing. Sorry, I'll pass on to Blake.
No, that's great. That's great, because those questions are important questions, and we got a lot of questions about the ping tree pricing, value of leads, et cetera, from our last webinar. So I know we can come back to that, talk about that in a few minutes. Before we do that, I want to turn to the legal expert on our panel, Blake Sims, and ask Blake if lenders are seeing new customers coming in, and maybe they're customers that we're not familiar with. We haven't seen them before. Maybe different industries, different credit profiles, certainly different credit risks. What are the sensitivities that lenders need to be aware of from a legal perspective as they're evaluating these new opportunities?
Yeah, just real quick. First of all, that's good news, right? I mean, from an operations standpoint, if you've got new customers coming in, that's new opportunity, and that's great for volume, which again, my clients are telling me things consistent with what apparently the data is showing, that volume is sort of the real issue right now. But from a legal compliance standpoint, if you've got new customers and they're not used to the product, they may not understand the product, they may be the first time that they're sort of in a subprime type of product. To me, legal compliance bells go off to say, hey, you got to make sure that these customers understand the product. You got to make sure that you're underwriting them properly. I think Phil talked about that they haven't really seen a difference between employment income and government benefits, but to the extent that there is a lot of government benefit, new applicants, you got to make sure that you're treating that income properly. So I think whenever you have new customers, You got to be really sensitive to, you know, you may have gotten sort of relaxed with your normal customer base. They understand the product, they understand the disclosures, they understand how you work, but higher risk with new folks.
Good, appreciate that. Let's shift gears a bit and talk about score bands, because this is another area where we had questions during the last webinar. And George, I know you've collected a lot of data about score bands. The general impression is score bands are not reliable anymore. So if lenders need to adjust their underwriting, should they? And if they should, what should they be doing? So let's talk about score bands briefly.
Yeah, so let me, you know, as we talk about scoring first, right? I mean, the first thing I want to talk about is how you can use the score to really, you know, address the whole quality of leads issue, right? And so as I illustrate today, I'm going to be talking about a specific score that we have in the marketplace, our Clear Credit Risk Score. It's actually a score that's used by a couple hundred lenders for decisioning or for underwriting AFS loans. And then I'll contrast that with some other scores, right? And so that particular score, the Clear Credit Risk Score, right? When it was developed, the target performance that was used was first payment default, right? And then another really important thing to note is that if you think about, you know, it's really a mixed data model in the sense that the inputs or the kinds of data that's used as predictors, right, in the algorithm itself, right, come from a couple different places, right? So in the case of this score, that particular score is calculated using a lot of clarity data and Experian data. On the Experian data side, it includes, you know, traditional credit data attributes as well as some trended data attributes. And then from the clarity side, in addition to rolling up the data that's being furnished by lenders, it also leverages a lot of that robust application data that's flowing in with each inquiry coming to clarity, right? And so there's a lot of diversity in terms of data source that are used as inputs into the model, right? And so I like it for that reason. If you contrast that versus, say, a more traditional credit score, say a Vantage score, right? A Vantage score is developed to predict serious delinquency over, say, a 24-month period, as opposed to the likelihood of just a first payment default, which is what the Clear Credit Risk Score is focused on. And then it's highly dependent on, as inputs, you know, credit data attributes, rolled up data coming from, you know, the traditional credit file 1 in the case of Experian. So, you know, what I kind of like about this model that's focused on first payment default, in my mind, it captures, really, it's almost like a blend of some different consumer behaviors. You get a little bit of that kind of evaluation of a consumer applicant's willingness to pay, but then you also get a little bit of intent to pay, right? And if you think about, you know, the composition of the score itself, you know, I'm not going to share the exact details of, you know, the proprietary algorithms, but what I can say is the composition of the types of attributes that are in the Clear Credit Risk Score, it tends to be weighted a little bit more toward a consumer applicant's stability, inquiries, recent credit data, and less so on, say, utilization and payment history, right? So in my mind, with all the noise going on right now in the marketplace, I feel like it's a fairly resilient, you know, score to be used to leverage, for example, things like credit quality.
Can I just jump in there and to George's point, you know, predicting behavior of new customers is key right now. I think a lot of lenders in the beginning certainly focused on their returning customers as a much safer bet in terms of collections, right? And that absolutely worked, but we're seeing returning customer volume decrease, partly because of the stimulus checks and other things that are out there. So it's incumbent now, I think, to find ways to lend to these new customers. And that's where conversion rates, credit scoring, sources of traffic all come together. And I think that's why we're here today, is to help find these solutions to funding new customers because of the cash that lenders are sitting on, and they need to find a solution. So I appreciate George's comments. And, you know, I think it's up to us to work together with lenders, credit bureaus, to find out how we actually put that money out to new customers now, not just returning.
So George, let me ask you, as a follow-up to what Phil is saying, you had mentioned that the clear credit risk score, for lenders who aren't familiar with it, that it helps you analyze willingness to repay and also intent to some extent. Last webinar, you also talked about ability to repay. Those three concepts are really interesting: willingness, intent, and ability. Does the clear credit score also give me information as a lender on ability to repay, or am I looking at other metrics for that?
Yeah, I think other metrics for that. I wouldn't say that that's, that the model's sensitive to necessarily ability to pay.
So you had given us a few slides about the CCR score, the clear credit risk score. Let's pull those slides up and just walk us through what we're looking at here so we understand exactly what benefits we have from the CCR.
Okay, so what we're going to be looking at, right? So I'm the analytical guy that likes to look at distributional results. So as you move from left to right, we're talking about week to week from the beginning of the year on through, from March on through May. And this is a stacked bar chart. So for example, what it's telling you is each one of the bars is basically saying if the total bar represents 100% of the consumer applicants that Clarity saw in that specific week, and we scored them using this clear credit risk score, it's showing how those scores distribute across the different score bands. So at the bottom, you see the lowest score band starts at 300, and at the top, the score goes all the way up to 850. And like with many other risk scores, high score is indicative of low risk, low score is higher risk. And as you look at these distributional results, as you move from week to week, one of the things that I would focus on would be kind of if you look at the pink bar and below, which maybe captures the total distribution of folks in the lower score bands, the higher risk folks. I think what's pretty easy to see is that in this case, for online payday applicants, we're seeing since about the second week in March, we're seeing that increase, which means we're seeing basically loan quality has been deteriorating, right? So we have more consumer applicants that are scoring in the lower score band. So we're seeing a deterioration in the quality of these consumer applicants. And then we also generated it for online installment. I'm not sure if we flip to the next page, I'm not sure if we included that one in there. We did, okay. And so once again, same general trend, only in this case, what you see is the timing's a little bit different, right? It really started to, right, the credit quality started to deteriorate a little bit later on, maybe in the second week of April, as opposed to the second week in March, right? But certainly this score gives you a pretty easy gauge for the quality of the applications that we're seeing.
And what about the CCR score by week by state? I found this chart interesting, but I'm not exactly sure what I'm looking at. Give me the quick summary of what this tells me.
Yeah, so lots of folks don't like looking at distributional results, so you can get a lot of the same, you can assess in a lot of the same ways by just focusing on an average score over time. Let's look at trends in the average score. And so, for example, the dotted line is pretty much, showing the average CCR score across all the consumer applicants that we saw at Clarity from week to week. And then what we've done is we've drilled down by geography. So in this case, we just picked out some of the states where there's a lot of AFS loan activity. And we've shown that similar trend in the average clear credit risk score for consumer applicants in those specific states.
Got it. So one of the questions that we just had is if the CCR score data is available for other states, similar to the chart that we just looked at. Is that data something Clarity provides?
Yes, that is available.
Excellent. One other question while we're on the CCR is another attendee asked if there is any short or medium term cross-pollination between Clarity and CompuScan, the African Alternative Bureau acquisition that Experian took.
Yes, so I have no knowledge personally of any of that activity to date, but something I can certainly look into, and if I can get the person that submitted the question, I can follow up.
And we'll do that. That was an anonymous question, which is fine. We'll take anonymous questions all day. And that's something that we could probably come up with an answer for our future newsletters. Let me go to Phil briefly. Phil, can you just touch on what you're understanding from lenders on the verification side of things? When we talk about ability to repay, really we're also talking about verifying what consumers are telling us. So can you touch on that briefly?
Yeah, and there's an interesting trend there, as George said, the overall quality is down of applicants across the board. Of course, that means you want to verify applicants much more than you normally would. And that's one of the reasons why conversion rates will decrease, is because you'll spend extra time verifying employment and you might find out that that person doesn't have an income, for example. Interestingly though, and I can't comment on different lenders' strategies, but I can only comment on what we see. I did notice recently that conversion rates for those with an auto fund campaign, which means the lead comes in, doesn't go to the call center, but goes straight to an e-signature page and funds from there. Those conversion rates had been higher, for example, than those with call centers. Now that makes sense, because as soon as you start verifying income, you get dropout. But interestingly, those lenders were prepared to tolerate a higher default rate on those loans, which is interesting. And again, I'm sure they have a particular strategy or a metric that tells them that that's going to work for them. But I think, there's a trade-off perhaps between conversion, FPD, and overall CPF. So I think there's a decision to be made sometimes between, are you willing to fund more loans and accept a slightly higher risk, or tighten up and be sitting on more cash. So that's an interesting argument.
Let's turn to our legal expert again and just ask Blake, are there issues when we talk about verification? What are the issues that come to mind as awareness points for lenders from the legal or compliance side?
Yeah, it's really consent, Jason. I mean, what you want, whether it's a consent to get the information directly from a third party, or whether it's the consumer giving that consent directly to their bank to provide it. Either way, however you have it set up and however you get that information, the consent needs to be clear. It needs to be clear as to what you're asking for, what you're getting. And one of the things is if you're planning on using to verify later on, your consent really needs to make sure that it addresses that. And I think Phil talked about the sort of the direct approval versus the verify then approve. You can get into some issues there, where is if you approve a loan and consummate the deal, and then you find out that maybe the consumer lied on their application and you verified it after the fact, that's probably likely a default situation as opposed to a denial of an application. And if it is a default situation, then you've got to look at your agreement and to look at state law as to what you can do in that particular situation.
Got it. So defaults, the takeaway there from what I'm hearing you say is, if you're in a default situation, this is a state law specific issue. There's no real federal issue to rely on. It's your particular jurisdiction.
Yeah, it's what your contract says and what state law says. That's right.
Good. Let's shift gears to something that Phil, you had started to touch on earlier, and this is acquisition costs, where I want to be in the ping tree. And I'm sure that lenders have approached you and said, we got to cut costs, drop the cost of leads. So maybe you can kind of walk people through the issues with ping tree pricing, acquisition issues, cost per funded metrics, and then we can get, after that discussion, we can get into where we can source the best quality traffic under the circumstances.
Yeah, I think that the ping tree has been kind of squeezed in the middle. Which means that the high quality traffic has commanded a higher premium, and the poor quality traffic is commanding a lower premium, if there is such a thing. So, because there's overall less volume, the demand for the quality is increased. So we've seen prices rise for particular traffic that's working well. I'm sure other lead providers will have seen the same thing. And to go back to what we said earlier, I think it's, the strategy should be to try different price point if your conversions are not working or your CPF is too high where you are. And we've been suggesting that to lenders, go with these particular sources, for example, that are pay-per-click advertising, which is working very well at the moment, radio and so on. We'll talk about radio in a second. Or try a lower price point, try clicks, for example. It's very easy to get traffic directed to your website at volume, and from there, you can find the right customers for you. So it's probably worth adjusting to find your CPF right now, because the ping tree dynamic is different. But it's certainly there. And as I said earlier, there are, some lenders in there who don't appear to have skipped a beat. And I don't have a great answer for why, I'm afraid. I think it's just because their models are suiting the current environment.
Well, it's interesting when you talk about acquisition costs. Some markets are going to be better than others. You had that Amazon slide, for example. So that's interesting that we can focus in particular areas, maybe for better risk borrowers, and avoid certain areas for other borrowers. But again, we go back to comments that Blake has made about potential discrimination or even disparate impact issues. We have to be cautious if you're segmenting your consumers that way. But so where are you reaching the best quality customers? Remember, we go back to the polling question, and the polling question, I'm going to put the results up again just briefly here. So we can see lead quality and conversion is too low, and lead volume is too low. So we've got two really conflicting metrics here. I need more volume, but I also need better quality. So what are you doing from a marketing perspective to draw in the better prospects and hopefully more of them?
Yeah. So the good traffic at the moment is the closest traffic to organic. In other words, if you're a lender, the best lead is one that just comes voluntarily to your website looking for a loan, and they always have very high conversion rates. For us, it's the pay-per-click advertising and the radio advertising, where people see products, they have an interest, and they straight away come into the system and plug in their details, and we connect them with a lender. So for those sources, I certainly would recommend upping your bids in order to get into that traffic. But there's still a lot of customers out there where there's a mixture, and new customers, maybe they have a thin credit file or something like that. So for that, I would recommend trying a different price point, potentially a lower one, so that you can see more volume, or opening up your filters and making sure that underwriting costs don't skyrocket, but adjusting your underwriting so that you can see more people and find customers to lend to within that. And that has worked for some lenders recently who have opened up their filters a lot more and allowed a lot more posts so that they can find their customers within it. So I would definitely recommend one of those two strategies.
And let me ask you about media channels in particular. I know part of my job as in-house counsel for LeadsMarket is to review new marketing initiatives, and that includes looking at radio and TV scripts to make sure that they're compliant. You gave me a slide about that. Should we pull that up and take a quick look?
Yeah, this is something that we touched on last time, and it's to do with radio specifically. You have the bar on the left is the average listening figures, and then we're comparing healthcare, police, and delivery drivers. And you can see that since the onset of the pandemic, and we talked about the delivery driver stat doubling since then, which makes sense if you look at the Amazon stat we looked at earlier. But also the police and healthcare workers are, as just one example of the different media out there, they're listening to more radio. Now, us as a lead generator, of course, that's of great interest to us. And this is why I know that others do too, but this is one of the reasons why we focus on our own traffic, because we can leverage metrics like this.
Good. Well, that obviously raises the issue on UDAP. So, Blake, since we're talking about radio, but advertising in general, I have seen some of the worst, shadiest marketing messages Some of them come to me via SMS, which has its own TCPA implications. But can you just kind of walk through the UDAP issues and anything else that comes to mind that touches on the marketing side, whether I'm buying leads or whether I'm doing my own marketing as a lender? Walk us through the legal issues there.
Yeah. So, first, if you're, lucky enough to have someone like Jason in-house with your company, obviously have that person review your marketing before it goes out. But, what we've seen is that, with volume being sort of the issue with a lot of our clients, they're wanting to be more aggressive with marketing, whether it's their own direct marketing or whether it's through, a lead provider or some other marketing company. And there's nothing necessarily wrong with having more aggressive marketing, but you got to be very careful, especially in a sensitive time like this, for a couple of reasons. One, because regulators are going to be very sensitive to anybody attempting to take advantage of the pandemic. I mean, we've already seen that. We talk to the regulators all the time. They're on the lookout for that. And then the other thing is as they expand into different areas, like radio and TV, that is sort of seen by a different audience, maybe than pay per click, then it gets that attention of regulators, plaintiffs, lawyers, other people like that. And so I just think as you get a little bit more aggressive, which you might have to do, be very, very careful. And what I say is have COVID-friendly marketing.
Yeah, I know that phrase, COVID or coronavirus, is a red flag the regulators are looking for. The thing that I always ask of our peers in the lead gen industry and anybody doing ethical marketing is this is not a race to the bottom. If the bad guys are going to do stupid things that are unethical, we're not competing. We're going to compete on a different playing field. So it's a sensitive issue, but I agree with you. Regulators aren't taking a holiday. There's no break here. We've got about 8 minutes left, so I want to ask George and Phil in particular, kind of the $100,000 question here. How do lenders continue to fund loans and find new opportunities in the COVID-19 era? So George, what's your practical, pragmatic takeaway there?
Yeah, so a couple comments. I know we spent some time talking about, for example, customers that are new to the AFS space. I think it's important to understand that there are models and tools that are available so that, for example, if we see a consumer applicant at Clarity, even in situations where Clarity hasn't seen that consumer before, we still have several scores that we can generate that are using other data outside of Clarity to be able to evaluate that consumer during the underwrite. A couple other things that we really haven't talked at all about, kind of different things that we see lenders starting to do, is think differently about, right, with focus on underwriting returning customers and focus on returning customers. We've actually revised our recommendations a little bit because there's so much more volatility in the marketplace right now. For a returning customer where maybe you haven't seen them in longer than 3 months, we actually recommend doing a full underwrite. And for consumers maybe that you have seen within the last 3 months, you do your MLA check and maybe you use a lighter version of a product to underwrite. And then the other thing, is, as you think about your borrower base, your existing customer base, it's important to focus on that continued cash flow from existing borrowers and stuff. And so we're talking to a lot of lenders about doing essentially these very quick portfolio reviews so that we can essentially come up with these triggers that basically will tell you for your existing borrowers, we can tell you things like ones where we've seen change in employment or income, or where we've seen some instability because we've seen changes in contact information, whether it be an email address or phone numbers or address, even changes in bank account, right? I mean, is this consumer going to open up a new loan tied to a new bank account? What does that say about the existing loan they have tied to the bank account that you have, right? So even positive and negative loan performance with other lenders, or knowing that another lender has already made an accommodation on a loan because of the pandemic, all that is valuable information that we can arm lenders with, so when they engage with their borrowers, they can have more productive conversations and basically drive better cash flow coming from even the existing customer base. And then my last point would just be, right, we've talked about demand's not quite there yet. It's starting to, right, it's starting to look a little bit better. You know, we see, you know, improving lender sentiment, and we see volumes picking up a little bit. But given, you know, the quality situation, just might, you know, prudent thing to do is don't chase poor quality leads. You got to maintain that underwriting discipline.
Good. Phil, what's your take? What can lenders be doing from your perspective?
Yes, I echo what George said. In terms of returning customers, they are very important right now, even if there are fewer of them because of the recent stimulus, but they're still a very good thing to be investing in. So to do that, if you haven't done it already, set up a special campaign to capture returning customers. Have a special price, a special list that as soon as that customer comes in and it's known to you, we can connect you with it immediately. Get your returning customers back quickly. Secondly, in terms of new customers, look high and low. Look higher in the ping tree for premium quality traffic, or lower your prices to allow you to see more traffic. Just make sure that you see as much available traffic as possible without incurring heavy underwriting costs, but just so you can identify the right customers for you. So open up your field of view, I think would be the way to say it. And thirdly, talk to us often, or talk to your lead provider often. Those who talk to lead providers often have better conversion rates. That's a fact. Because why? We adjust much more quickly to changing circumstances.
Good. Let me flip it back to Blake real quick. Blake, can you give us kind of a 2-minute summary of the legal considerations? I just put your slide up on the screen, but walk through these issues, please.
Yeah, real quick. And the one thing that I really want to mention is probably the biggest takeaway that I think everyone should get from my portion is what we're seeing is likely to be the biggest litigation point coming out of the pandemic is over the CARES Act and FCRA issues. And what we've had some discussions about and clients ask us about is, can I look at the trade lines that might say affected by natural disaster, or might say forbearance, or might actually mention COVID, even though there's not a specific COVID code. Can I look at those trade lines and deny people immediately based on that? And what we say is that there's risk in doing that if that's the sole reason that you're denying someone. You can use those codes to sort of look into the matter further and use other sort of objective criteria to deny them. But if you're just denying someone solely because of that trade line, we think there can be a COA, FCRA, and UDAP risk there. And we've already heard that plaintiffs' lawyers are really looking at those issues and thinking about bringing actions on that. So that's probably the biggest takeaway. Other things, just stay informed, watch debt collection practices because delinquencies are likely going to rise. We've already talked about, be careful with COVID marketing. And then, don't forget about non-COVID legal and compliance issues. Those are still out there. The small dollar rule is coming. CCPA goes into effect July 1. If you're still in California, you might need to be ready for that. And pay attention to things of interest that are happening out there, like the Supreme Court, the bar case. It's a TCPA case, very important. The FTC still bringing actions against service providers. There was a very important case today out of the 7th Circuit, the TransUnion case that tribal lenders ought to look at. Very important case. And so those are some of the quick hits and things to take away.
Good. I appreciate that. Let me ask George first and then Phil. Any parting thoughts? We've got about 1.5 minutes left, and my dog's going to start barking at somebody in front. So any parting thoughts here that you guys want to share with us on the way out?
Well, I mean, the parting thoughts are, right, it looks like, things are beginning to rebound a little bit. In talking to a lot of lenders, the sentiment is definitely improving. I'm a risk management guy by trade, so I certainly say be careful with compromising your underwriting standards to chase volume. I mean, I can't say that enough times. And, we're here to help, right? So. Good.
Phil.
I'm going to quote a lender here who said that there is a risk of lending right now, but there's a greater risk of not lending right now. So let us work with you and Clarity and others to find your sweet spot within the system. But as George says, without giving up your underwriting criteria, but maybe you need to find a slightly different one to service the current market and talk to your lead provider in order to get you there. Volume is up, but we have to be careful how we work together to make sure your CPFs stay in line.
I appreciate that. And thank you guys, excellent panelists. I appreciate the expertise you bring to the table. But let me just get on my soapbox for 30 seconds and remind everybody in this industry that we serve a very important purpose. Subprime borrowers need a safe, ethical, legal place to go get money when they are in need of it. They don't have access, we all know this, but let's remember it's really important. They don't have access to traditional resources that you and I might. They can't pull out the credit card. They can't go draw from their line of credit. They can't go get a traditional loan from their bank. So we really do serve an important purpose. And when we do the things that we've been talking about today with respect to the legal issues that Blake talked about, we have ethical marketing, we have good practices looking for the right credit risk people to lend money to who have the intent, the willingness, and the ability to repay. We are doing a good thing for people. And by the way, the better we do as an industry, the safer we are for those consumers who otherwise would be stepping outside of legal avenues to get money or to get help with what they need the most. So we should be proud of what we're doing. Last thing I'll say is this industry has said over and over again that we are innovators. We believe that we are part of the fintech industry. So don't be afraid to innovate. Phil mentioned it, George mentioned it. Be creative, step outside the box, think of things you haven't thought of before, because frankly, nobody recognizes where we are anymore anyway. This is uncharted territory. So don't be afraid to take some calculated, educated risks and use the resources that we've given you today. Blake can help you on the legal side. George and Clarity can help you on the underwriting side. LeadsMarket, whether we work with you or not, we're happy to talk to you because we want this industry to succeed. We want all of our partners and friends in this industry to succeed. So thank you guys for your attention. Thank you to the panelists for your expertise. And we will be back with more. Just wait for it. Announcements are soon to come, but thank you guys and have a safe and fantastic day.
Thank you, Jason.
Thank you.